Hello, dear students. Welcome to Adrian Academy. So, today we will be knowing about behavioral biases in cryptocurrency investment. So, we'll see what is cryptocurrency and behavioral finance, how it is linked to the investment decisions. So, behavioral finance basically studies how emotions, psychological factors, and cognitive biases influence financial decisions. Cryptocurrency markets are highly volatile and largely driven by investor sentiment, making them a perfect environment to observe behavioral biases such as we have herd behavior, FOMO, and panic selling. So if we go on to the next one, we'll see what is hard behavior in crypto trading, what is FOMO, that is fear of missing out an investment decision, and investor psychology during crypto crashes. So first, let us understand what is behavioral finance. So behavioral finance combines psychology and finance to explain why investors often make irrational decisions. See, basically, traditional finance assumes that investors are rational and always seek to maximize the returns. However, in reality, investors are influenced by emotions such as fear, greed, excitement, and regret. In cryptocurrency markets, where prices can rise or fall dramatically within hours, emotions often dominate rational analysis. This leads to decisions based on market sentiment rather than fundamental value. So, we'll study about basically decisions influenced by emotions. Investors may ignore facts and logic. Market movements are often amplified by psychological factor. Social media significantly affects investment behavior. So we'll see what is cryptocurrency market overview. Now, cryptocurrencies are digital assets that use blockchain technology for secure transactions. Unlike traditional financial assets, cryptocurrencies are decentralized and operate without central authority such as banks. So some of the characteristics of cryptocurrency markets are these are very high volatile and 24 bar 7 trading, easy accessibility through mobile apps, and strong influence of social media and online communities, and limited historical data compared to traditional assets. So because of these characteristics, investors often react emotionally to market events. So understanding biases like behavioral biases are systematic errors in thinking that affect decision making. Common biases in cryptocurrencies investing are we have herding bias. Herding means following the actions of the majority without independent analysis. Next we have FOMO, fear of missing out. So basically we fear of missing a profitable opportunity. Overconfidence bias, believe that one's knowledge or skill are superior to others. And next we have confirmation bias. Confirmation means seeking information that supports existing beliefs while ignoring contradictory evidence. Loss aversion, feeling losses more intensely than gain. Then lastly we have panic selling, means selling investments during market declines due to fear. These biases often work together and significantly affect cryptocurrency investment decisions. Next, we'll move on to hard behavior in crypto trading. See, basically, hard behavior occurs when investors imitate the actions of others rather than making decisions based on their own research. Many crypto investors buy or sell because everyone else is doing the same. Like basically, you're following the crowd. See, example, we can say when Bitcoin start raising rapidly, investor observe other making profit and begin purchasing Bitcoin without evaluating its actual value. So why we have the reason for herd behavior is because of the lack of financial knowledge, trust in collective decisions, and influence of friends and family, and fear of being left behind, social media type. So these all will influence or causes the herd behavior. So we'll see in the slides how herd behavior works. Okay, the step by step process. A cryptocurrency experiences a price increase. Early investor earn profits. Success stories spread on social media. More investors enter the market. Demand increases significantly. Prices rise further. A speculative bubble forms. Prices eventually collapse when demand declines. So, what will be the result for this? So, investors who join late often suffer heavy losses. We'll see one real life example. So this Bitcoin reached record highs as millions of investors enter the market. So we have something called as Dogecoin phenomenon. So this Dogecoin phenomenon originally created as a joke cryptocurrency. Dogecoin experienced massive growth because celebrities promoted it, social media users encouraged investment, and investors followed the crowd. So basically, the consequences was the public price bubbles were increased, and the market was volatility, increased market volatility, and significant losses after the market corrections. So these are the some of the examples of herd behavior. Next, we'll move on to the next topic of FOMO, that is fear of missing out. So, fear of missing out is a psychological feeling that others are gaining opportunities while one is being left behind. In investing, FOMO motives investors to buy assets simply because prices are rising. So, example, if an investor sees Bitcoin rising from 50,000 to $60,000 and fears missing future profits, they invest without conducting proper research. So, we'll see what are the causes of FOMO. So there are social media influence. So influence means like investor constantly see stories about others earning substantial profits, and news coverage which talks about media reports often highlights successful investment. Peer pressure, friends and colleagues discussing crypto gains create pressure to participate. Fear of regret. Investors worry they may regret not investing if prices continue rising. And celebrity endorsement. Influential personalities can create excitement around specific cryptocurrencies. So, what is the effect of FOMO? There are positive as well as negative effects. Positive effects are increased market participation, higher liquidity in markets, and greater awareness of cryptocurrencies. Negative is buying at peak prices, means like investors often enter the market after significant prices increase. Poor risk assessment, investment decisions are made emotionally. Financial losses, prices may decline shortly after investment. Emotion stress, losses create anxiety and regret. So these are the little about FOMO. For the next, follow me for the part 2 video. Thank you.